everyone, it's Josh. We are checking in with Nick and Jessica, the co-founders of DataTrek Research and the authors of DataTrek's morning briefing newsletter, which goes out every day to 1,000+ institutional and retail clients. Nick and Jessica also have their own YouTube channel, which you can find a link to in the description below. Hello, Jessica. Hello, Nick. How are we?
Hey, good.
Well, thanks. How are you?
I'm doing great. I look forward to this every month. I wanted to talk about what you guys were writing in terms of new highs. I think that's a really great place to start. Improbably, we are seeing new 52-week highs in a lot of areas of the market, which even 6 months ago, most of us would have said that seems a little bit unlikely. And so I guess the best place to start for that kind of conversation would be Europe. Let me set the stage here with a couple of charts. I'm showing you MSCI Europe, which is the top pane, followed by MSCI European Financials, EUFN, and the bottom pane is MSCI Small Cap Europe. And of course, these are all the ETFs that are based on those indices. Next chart, I'm showing you emerging markets, EEM on the top, and MSCI EM small caps on the bottom. And lastly, I'm going to show you 5 major banks: Goldman Sachs, American Express, Bank of America, Citigroup, Wells Fargo. What all of these have in common is they're making new 52-week highs. And the question becomes, if that's the backdrop, it's pretty hard to find a reason to look past that and be bearish. Nick, I think that was your conclusion in a recent piece. Do you want to talk more about that?
Yes. I mean, this comes into the sort of what else do you need to know about the market kind of observation, because when you have this level of 2-week highs across assets that are pretty different, Europe versus US financials versus EM, very broad-based rally, all 52-week highs. It's like, what else do you need to know about equity market sentiment right now? It is overwhelmingly positive. And this flies in the face even of the dollar. The dollar has been stronger this year. You would expect, given all the charts you just showed, the dollar to be a little bit weaker. It's not. It's been stronger. The best thing you can expect the euro is that it's stabilizing. Yuan stabilizing.
Yeah, you talk about this being a classic kind of mid-cycle market. This is what mid-cycle markets look like. Can you get into a little bit about some of these that you've seen before and why this feels like it's right on track?
Yes. So I started my Wall Street career in 1986 full time. I was a phone rep at the old Alliance Capital. So pre-internet, pre-everything, you need to call somebody at the mutual fund company to find out what was going on. So I had a lot of conversations with brokers and retail investors. And the issues then were, hey, when's the Fed going to move next? And how long can this go on?
In 1986.
In 1986. So the Fed, people forget, the Fed had cut rates dramatically in 85 and 86. That's what led to the big bull market in 85 through 87. And so everybody was very aware that the Fed was driving a lot of these stock market gains, and they wanted to know how long it was going to last. They wanted to know how long it could go on. It was very similar conversations to today, which is kind of freaky considering it was 30 plus years ago. And that's what tells me is this is a mid-cycle market. The 80s were a mid-cycle market, even with the 87 crash, lasted all the way to 90. The 1990s, same thing. The mid-2000s, same thing. That long run from 2012 to 2019, all the same thing. These are the pushes and pulls that we get during mid-cycle markets. And the financial slide that you showed with all those big brokers and big banks, financials are a leadership group during the middle part of a cycle. They crash at the end of a cycle, obviously, because loan losses go up dramatically. They begin to recover, and they kind of grind their way higher for years and years and years. And so that's the kind of market we have.
What's so tough about this is nobody waves a flag and says, okay, congratulations, we're now in the mid-cycle. And there's also, there's no calendar for how long it's supposed to go, or when it's going to end, or what's going to end it. So a lot of investors spend the entirety of that time being in the mid-cycle thinking that they're a late cycle, because it's human nature. This, especially when you're just making money and it's almost like, well, this is too easy, or this feels too good. Surely someone's about to pull the rug out from under me.
Yes, it's so true. When you look at the history of returns, you look at, we've all looked at these long, annual return data sets and thought, oh, wow, the 80s were easy, the 90s were easy, the mid 2000s were easy, all of the 2010s, hey, aside from the crash, things were great. Must have been super easy to just print money and be a good investor. And it never is. It's always something. There's always things to worry about. It doesn't mean the cycle's at an end. It just means that's the normal way the markets operate. Some things are good, some things are bad, some things are in between, but in general, corporate earnings go up and stocks go up.
We are going to talk about earnings a little bit later, but one interesting factor buried within all of the transcripts of the conference calls that we heard from S&P 500 companies is that almost none of these CEOs or CFOs is talking about recession anymore. I think we are hitting a cycle low in people referencing recession in their comments to analysts. So my question would be, when you talk to investing clients, like, are they on board with your idea that we're mid-cycle, or are you still getting as much pushback as maybe you would have gotten a year ago with that kind of story?
There's always pushback, and I was actually just speaking at a big corporate conference here in New York last week with all C-level executives of major U.S. banks and other firms based around the New York area. And I asked the group, okay, how many of you are worried about a recession? And half of them raised their hands. So
Still,
they're
okay.
still, they may not want to express it on calls because they don't want to seem like they're trying to ring the alarm bell or make excuses for earnings or for, reductions in estimates, but there's still that underlying tenor of concern. They see the economy as okay, but not great. They look at their companies and they see a little bit of an excessive cost structure, which we'll get into in the next segment, but they're not as confident as the market is. They don't, when I show them, high yield bond spreads, which are near record lows, same with investment grade, those things say no recession, absolutely not going to happen, period. There's not that level of confidence either with our clients or with corporate America.
I think we're making progress, though, because if you would have asked that question 1 year ago in the spring of 2023, how many of you were worried about recession? You probably would have been 75%.
Sure. I
So,
mean, inverted yield curve and,
yeah,
uncertainty about how
bank scare,
big bank scare. Yeah. I mean,
right?
that ripped spreads higher for a good 2, 3 months and they came right back down. So, yes,
Okay.
you're right. I mean, general tenor is pretty constructive. But we'll get a recession scare again. We always do. That's another hallmark of mid-cycle markets.
I want to show you two more charts, okay?
Okay.
All right. These are very simple. Industrial sector, Spider, which is the XLI, is the purple line, up 23.61% over the last 6 months, leading the S&P 500 up 19%. So both are positive, but you can clearly see where the industrials started to pull away late January, early February, and they remain a leadership group, I guess, alongside financials. One more. This is basically the same idea. S&P 1500 industrials, which is not an ETF. This is an index. And I'm showing that to you versus the S&P 1500. And you're seeing the same exact separation with industrials leading the way. And this chart is showing us all market caps. So it's not just a handful of defense contractors in the S&P, for example.
Right.
Right. So it's very broad based. And I would point out, this industrial leadership is taking place with a notable bomb being dropped on Boeing over the last couple of quarters. Like, you're not even getting the benefit of some of the stocks that make up this group. So I think this fits well with the mid cycle narrative. When you see industrials leading the overall market, that's got to feel like it's a little bit of confirmation, right?
Yeah, absolutely. The classic mid-cycle sectors are financials, like we talked about, industrials, healthcare, which has not worked this year, is often a mid-cycle kind of market. I think it's kind of on the outs right now, but it should come back at some point. And then tech. Tech is usually a
Mm.
mid-cycle, a good mid-cycle sector. So yeah, that all fits exactly.
Want to ask you one more thing. So these rallies in small cap and Europe and emerging markets that we started out with, we haven't really seen a lot of follow through in these bull markets or these rallies. They tend to, and this is anecdotal. I haven't run any numbers, but I feel as though they're rotations or they're phases, and they tend to take place over 6 weeks or 8 weeks. And people get excited about the small cap rally, and then the rotation ends, and that doesn't necessarily mean it's a non-confirmation and you want to sell the S&P. So I guess like we like when they're rallying, we look at that as confirmation, like, look, this is a real bull market. But then when they falter, it's not as though we cool off on the real bull market. We lost that confirmation, but we almost seem not to mind. We say like, oh, EM's not rallying anymore. Who cares? What do you think
Yes,
about that idea?
very, very fair. And I thought a lot about this, in the context of Wednesday's CPI print, because obviously the whole world's just hyper focused on that. And will it confirm rate cuts this year or not? Obviously, the world, all those charts you showed, all say that the CPI story is kind of going to be past us soon. We're going to get some rate cuts. Things are basically going to be as expected. Not as good at the beginning of the year, but still some rate cuts this year. If we get a hot CPI number and these rallies kind of stall out and begin to fade, as they have done repeatedly, as you rightly point out over the last 2 years, you're right. I don't think we are at the end of the bull market. We're going to just, those groups will have ended up looking overextended. I just find it's odd that we have these simultaneous rallies in big cap financials, small cap EM, European banks that have been like the sickest sector in the world for the last 5 years, 10 years, even back to the financial crisis, and all they're making 52-week highs. That to me provides a level of confidence that I think feels pretty good right now.
My theory on the European banks is it's all tourism from the U.S.
That's not a bad one.
Like the Greek economy and the Italian economy have never looked better, and those are the two riskiest credits for banks in Europe to have to normally worry about. And like for right now, U.S. tourists have bailed out those economies, so there's almost like very little to worry about if you're a big European bank. So that's my working theory. Jessica, we have 2 weeks to sell in May. So should I get a head start on that now, or can we hold and see what happens?
Yeah, so it's that time of year. We often see people talking about the old saying of "sell in May and go away." So we put it to the test by looking at the S&P 500's returns from January through May, then June through October, and then November through December back to 1980. And as you can see in the table up on the screen, while it's true that the S&P's average performance has been meaningfully weaker from June through October versus January through May or November through December, it's still positive. So not being invested from June through October leaves money on the table. And
Mm,
you can see the differences in seasonal performance more clearly with the next chart that show this. So this shows the S&P's compounded returns from January through May. That's the blue line on top. June through October. That's the orange line at the bottom. And November to December. That's the green line in the middle. Each year from 1980 to 2023, indexed to 100. So basically, this chart just shows you how much you would have made owning the S&P over just these months from 1980 through last year. So, for example, had you been invested in the S&P from just January through May of each year from 1980 through 2023, you'd be up 531% on a price return basis. Being invested just from June through October, you'd be up only 76%. From November through December, you'd be up 297%. However, by being invested all year from January through December, the S&P's total return is positive 4,300% since 1980. We couldn't even put the line on this chart because it would skew the y-axis so badly. It just blows the other strategies out of the water. So overall, the takeaway here is it's definitely better to stay invested all year rather than trying to play seasonal trends.
let's put that chart back up, John. So one thing that stands out to me is that every one of these time periods from 1980 through 2023, which I think most people would agree, that's a pretty healthy sample size. Every one of these monthly or these multi-month time periods features positive returns over time. We don't have any definitive periods where historically it's really made sense to be out of the market, but you do have a much better experience with, for example, January through May than you do June through October. Like that's also undeniable. So my question to you, Jessica, would be: do you have a working theory as to why that's the case?
Yeah, it just so happens that from June through October, that's when we've seen some large economic or oil shocks. They've just happened to occur during that period. So some of the like the five worst years, which you'll recognize all of them, for example, were 1990, 1987, 2001 and 2, and 2008. So the takeaway from that is if you expect a big exogenous shock in the next few months, then sure, sell this month. However, you better be super sure that's happening because they're very unpredictable and you're more likely to lose out on incremental returns.
Nick, on the same topic, just thinking out loud, if there were such thing as some sort of a seasonal buy and sell that were even close to being statistically helpful, wouldn't it already be exploited into the Stone Age? You don't even need an algorithm for that. You need a calendar.
Yes.
So like, how could something like that really persist?
The short answer is obviously it cannot. There's just some oddball things that happen, and they end up being market lore and market superstition, like crashes happen in October. Okay, yes, historically they have, but it's like the old Mark Twain saying. It's like the most dangerous months to invest in the stock market are basically all of them. You
Yeah.
just have to sort of put up with that occasional exogenous risk.
I think there was an agricultural reason for the frequency with which October was a dangerous time to be a speculator in commodities and stocks
Yes,
100 years ago. Like the
yes,
logic that the farmers would have to call back their money from New York and Chicago so that they could pay the farm hands to bring in the harvest.
yes.
There was some rhyme or reason why the gold would have to leave the cities. Therefore, that would lead to forced selling of securities so that the banks could send the gold back home to the
Yes.
prairie. All right. But we
No,
don't live in that world anymore.
I have some old stock market newsletters from the 1920s, which are very
Yeah.
cool to read, and they mention this exact topic right
Right.
around May. Yeah, this
Right.
goes back this is a 100-year-old theory.
Yes.
And I think originally it did have some. The Fed was very young in the 1920s. It's only been around since 1913. So
Right.
it still was trying to figure out, how to get money around the country. So it was probably true back then.
So next time we could tackle sell in July and wave goodbye, which is the new one. That's the new one that Jeff DeGraff shared that one with me last week. So maybe you guys can take a look at that. I want to talk about the longest running mystery on Wall Street, or one of the longest running mysteries on Wall Street. And I'll frame it, Nick, and then you can explain it. Why are analysts overly optimistic on full year earnings projections, but systematically too pessimistic on quarterly earnings projections? Why do they err to the downside in the short term, but to the upside in the long term? What is that about?
Sure. I mean, I can tell you, I was a stock analyst for all the 1990s. I was at First Boston. I was the guy, doing buy, sell, hold on GM and Ford and Chrysler, and doing these earnings models and talking to companies. And there's a couple of reasons. Excuse me. There's a couple of reasons why. As far as why analysts are always light on the quarter and why we get all these upside surprises in quotes. Like Q1, we just saw reported 78% of companies beat their estimates by an average of 7.5%. If you go back and look at where estimates were, say, over the last year, and look at where they ended up, analysts usually have the right number pretty right at the beginning of the quarter, like they're weighing 2 or 3% up or down. Then they always cut through the course of the quarter, and we end up with these beats of running roughly, call it 7%.
Yeah.
And 75% of companies beating. And it's because the companies are talking to their analysts over the course of the quarter, nudging them down, pulling them down a little bit, saying, hey,
Sandbagging.
yeah, are you sure your SG&A line is right? Or, hey, we're having some issues with product mix this quarter. We talked about it at the last conference. Analysts get the hint. They cut their numbers. They mostly have buy ratings. They want to see their companies beat. And so the numbers end up coming in too low. The companies outperform, and they're able to go on the morning call and say, hey, my buy rated company beat earnings by 6%, maintain my buy. And that's the whole story.
Everybody wins. Everybody wins when the hurdle is low enough that the company can beat it and the analyst looks smart. They had the number right, but then they also had the call right. So it feels like it's a virtuous circle. Why would we want to interrupt that with accuracy?
Yeah, it's sort of a Lake Wobegon market. All the children are above average.
Right. Okay. So, and that's playing out now. And I think you have some really important points about this, as far as like how that shakes out and what that means to investors trying to understand the impact of earnings on their portfolios.
Yes, the bottom line is only a beat that is above 6.7%, so call it 7%, which is the 10-year average of an earnings beat. Only above that number is it really a beat. Anything
Okay.
less than that, it's basically in line. It's not a beat. So there's a little bit of, okay, my company beat. Well, did they really? They only beat by 3%. That's not very good.
So if you beat by a penny, yes, on paper, it's above earnings expectations, but it's not meaningful because of the average beat is so much higher than that.
Yes, and that's one thing every trading algo knows. They know these numbers. They know it down to the sector and subsector level. They know it for the company's earnings history. This is why stocks react so quickly to earnings, because the algos are looking at those numbers and running them against the longer term averages.
Okay, why are the annual estimates always too high?
Oh, this is the greatest mystery on Wall Street, and I think we have a chart that was actually from McKinsey, published in 2010, and it shows that this is the street's numbers expressed in those little green squiggles for the S&P 500 earnings for the year, and
Where
then
they
the blue.
start and where they end.
Right. The blue dot is where they end. The green line shows the trajectory. And you can see that these
This is
lines go
great.
down every year from 1985
Yeah.
through 2008. And this was published in 2010. And then the data is exactly the same. The phenomenon is exactly the same for the last 10 years. And it shows that analysts always start too high and end up lower, with the exception of 2005 and 2006 over on the right hand side of the chart. And those numbers go up because we had a really strong economy fueled by a housing bubble, so numbers went up. Other than that, numbers always go down. And the reasons are twofold. The easy reason is sometimes you get a recession, and obviously the recessions kind of hit mid-year and the numbers are too high, they have to come down. That's entirely understandable, and that's fine. But it also happens in every other year. And the simple reason why is that companies start the year with a certain set of expectations they tell the street. And the street puts it into a model. Okay, revenue growth is X, fixed costs are Y, earnings are Z. I'm done with my model. What happens, and this happened to me over and over again in the 1990s with all the car companies, all the suppliers, was all these companies add incremental costs through the course of a cycle. So if they start with a very lean cost structure after a recession, they start adding costs. And I can't tell you how many conversations I have with companies of all kinds all over the world to say, okay, your numbers are okay, but why weren't margins better? And invariably the answer was, well, we had to invest for future growth. We had to hire new people. We're looking at new product lines. And it's that kind of cost creep that creates that negative incremental margin pressure. So you have to lower your numbers.
Growth costs money.
Growth costs money, whether it be
Right.
investment money or cost money. It appears on the balance sheet, it appears in the cash flows, and it appears in the income statement. But since we're focused on earnings, it's that EPS effect that's most dramatic. And so numbers have to come down. The only time this cycle reverses is going into a recession and during a recession. Then all those incremental costs go away, and you start with a new baseline of margin structures. And the whole cycle repeats itself. But the end effect is you have this constant process of bringing your numbers down. And so, it's the biggest rookie mistake to think that the analysts are expecting whatever 270 a share for the S&P next year, and that's going to happen. It's not. Those numbers always come down.
So this is an interesting question. The analysts know this, and yet it still persists. So one idea might be, if you run a corporation, one of the things that you're doing internally is setting targets. You're telling your employees, this is what I want you to, this is what we think is doable, and this is what I want you to hit or exceed, for your bonus, for example, or for a promotion. So targets are normal for companies to have an internal. The problem, I guess, comes when a target transmogrifies into an expectation. So now it's like the CEO just set this guidance internally for what they want their employees to do, and all of a sudden, enough people hear it like telephone, and it goes from being this is the target to this is what we forecast. And
Yep.
companies don't always hit their targets, of course, but if the target becomes a forecast, then you could understand why the sell side gets infected with a certain number, and that number then becomes like, oh, here's our expectation.
Yes, and look, I mean, there's other some offsetting factors as well, like product mix improves during an economic expansion. Units sold tend to be better than expected, so companies feel they have some leeway on the cost structure side. But that'll come to bite them, at various points in a year when demand doesn't come through and when mix deteriorates. And so again, you get these numbers coming down.
So I want to quote you to you because I think what you've written in this section is a perfect explanation for the experience of 2023 and so far 2024, especially when we're talking about the largest companies in the S&P, the tech giants. This sounds exactly like what we've just experienced. You write, during periods of stable economic growth, it's hard to model incremental earnings, and here's why. Let's say you're modeling a company with $1 billion in revenue with 10% operating margins, and you expect them to grow sales by 10%, which would be another $100 million in revenue. That $100 million in revenue doesn't come just on top of the existing revenue with no additional expenditure. To the point that you just made, you're going to be hiring people, you're going to be buying equipment, you're going to be doing the types of things that you need to support that growth. But then all of a sudden, when you get into a recession and you have, or what feels like a recession, and then you have companies reporting these incredible margins and earnings, you point out that's because they're not making those same investments that they were making on the way up,
Yep.
or they're cutting them out of the picture entirely, which leads to the types of upside surprises we got at Meta, we got at Netflix, as they started to rationalize from the go-go growth era of, let's say, 2021 to the almost austerity of 2023. So I think that's like almost a perfect explanation for why, and the Bears hate this, but you have earnings beats at Apple, at Microsoft, that even if there's no revenue growth, you're still getting these upside earnings reports. Do you think that's kind of like a good explanation for what we've just lived through?
Yes, absolutely, and it's not just tech. If you look at Q1 results for the S&P as a whole, earnings beats above average, amount of beat above average, revenue growth way below average, number of
Yeah,
companies beating on revenue growth way below average, like 59% beat on revenue growth versus usually 65 to 70%. So we've had a very bad revenue quarter relative to expectations. We've had a
yeah,
very good earnings quarter, and that shows you like every company is doing this. They spent the last 2 years hiring anybody with a pulse that could possibly help them grow revenues. And
yeah,
now with revenue growth slowing, they're saying, okay, we got to cut back. We got to cut back. And that's what's happening. And it's margin management. That's totally fine. It's also why analysts expect earnings to improve so much in Q2 and Q3. Expectations of like 7% incremental sequential growth for the next 2 quarters. We usually
yeah.
get 2. So the market's saying, okay, if it's cost structure led earnings beats, I'm fine with that. Just give me the numbers.
Yeah, and even if they're not doing layoffs or announcing them publicly, when they stop hiring, that will eventually be a positive earnings impact in the next quarter, where they would have normally hired X number of people. So even a hiring freeze ends up helping on the earnings side, has nothing to do with the revenue side. So I
Yes,
think,
and it could be hiring, it could be consultants, it could be T&E. They have so many levers that they
yeah.
jammed forward over the last 2 years they can pull back on to hit their numbers.
So did we sort of solve the lingering mystery on Wall Street,
Yes,
or
the lingering
okay?
mystery is incremental margins are extremely hard to predict. And anybody who's
Okay.
done a model knows that. But if you haven't, just take our word for it. It's ferociously hard. And that's why the numbers are always too high.
Okay. Jessica, on venture capital, you've observed that we're really not seeing an increase in the investments that are being made. But big tech also is eating up an increasing share of the amount of money going toward venture capital deals. I suppose they have the money, and they certainly have the strategic desire to be early to these things. What do you see happening here right now? We have a great chart of this, by the way.
Yeah, so we looked at big tech's R&D spending versus venture capital outlays because big tech as the incumbent can be potentially disrupted by hot new startups getting funded by VCs. So to set the stage here, let's first just look at, as you can see on the screen, that shows big tech's R&D spend over the last 3 years. Though I just want to note real quick, the only big tech name we excluded is Amazon because it doesn't break out its R&D spend.
Mm,
But two points here. First, that's important to point out is that these 6 companies make up a quarter of the S&P 500. So their R&D spend is an important driver of not just the individual business's long-term growth, but the US equity market as a whole. And second, these 6 big tech companies increased their R&D spending by an average of 44% from 2021 to 2023, despite 2022's bear market. So for us, the biggest takeaway from this table is while big tech's higher profits enable them to spend more, not even the Fed's latest tightening cycle slowed any of these companies down in terms of investing for the future.
So how does their increase in spend? So what percentage of the R&D budget is venture investments in third parties or other companies? Would you guess, or would you say?
Yeah, so it's broken out. It's separate. So we have another chart to show you that'll help answer that. Is this shows big tech's aggregate R&D spend in comparison to global venture capital funding over the last 3 years, and the numbers here are in billions of dollars. So what this shows, just 3 points on this, is the first is that VCs pulled back on funding startups worldwide, even as big tech companies increased their spending on R&D from 2021 through last year. So VCs pulled back funding by 59%, whereas big tech's R&D spend were up 44%. I think what you were referring to that leads to my second point is that big tech's annual R&D spending as a percentage of global VC funding has risen from just 15% in 2021 to over half last year. And third, big tech has also dominated much of AI related VC investing over the last year, and those rounds aren't in these R&D numbers that I showed you. So think like Nvidia, Microsoft, Amazon, Google, they were all involved in the largest AI rounds worth billions of dollars. So think like ChatGPT owner OpenAI and its rivals Anthropic and Inflection AI. So it just goes to show that big tech R&D spending is a structural growth story, but global VC funding is much less reliable, and this just gives big tech incumbents an edge over newer VC funded businesses, especially as big tech increasingly invests directly in AI startups themselves.
I was also going to say that there's a component to this that looks a little bit like vendor financing. Of course, they don't look at it that way, but ask yourself the question when Microsoft and Alphabet and Nvidia are spending all this money on R&D, a lot of that money ends up going back to each other in the form of cloud compute or equipment or chips. So there's kind of a virtuous cycle there. Of course, we know that at some point that does end. It's not infinite. What are your thoughts about what that tells us about these ecosystems? Like, can they stay healthy for a long enough period of time where the earnings continue to be fueled by the R&D itself?
Well, I would look at it this way too. Like one of the reasons why they are investing in AI startups is because they're getting so much government scrutiny. So it gives them a window into still being at the table because they can't make as many acquisitions. So they're able to also just keep investing in AI startups and get exposure that way.
Yeah, and I think if they invest in an AI startup who then takes a portion of that invested capital and buys back cloud computing services, like it's everybody looks good in that scenario, and we've seen that before. What's your takeaway to somebody that says that there's some negative or positive having less venture capital? Having less venture capital investments being made and more investments being made by the 6 largest companies in America. Do you view it as either positive or negative, or it's just a fact of the current environment and shouldn't matter terribly for investing in the long term?
Yeah, I just think that ultimately it proves that big tech can hold its competitive advantage even with VC spending hundreds of billions of dollars over the last few years. Big tech may not spend as much, but they're consistent and they grow their investments every year.
Guys, I want to thank you so much for joining me today. It's always a pleasure. I want everyone watching and listening to follow Nick and Jessica's video channel on YouTube. There's a link in the show notes. And of course, you can go to youtube.com/@Nick Colas and Jessica Rabe if you want to get a jump on that. And of course, you can subscribe to DataTrek Research at DataTrekResearch.com. Nick, Jessica, thank you guys so much. And we'll check in with you soon.
Thank you.
Thank you.